today is that the Reserve Bank yesterday announced that it will conduct variable rate repos every working day, thus signifying a major change in the availability of liquidity in the market. Now, this announcement, along with the cooler than expected US core CPI, has pushed down the bond yields. Latha is joining in with us to explain us all of this and what it means. Latha, good afternoon.
Well, the Reserve Bank has restarted daily repo. What is repo? Repo is a means by which the central bank of any country gives money to the banking system when it needs. So this had gone away into a 14-day repo. Some time back, 2020 was when it got written into the RBI rules that they won't do daily repos at all. They will do 14-day repos. Now, often what the Reserve Bank actually is trying to tell the banking system is that you make an assessment of what will be the deficit for you over 14 days and take that money from us. We will provide the liquidity. It was trying to tell the market, I will not be your treasury manager. You have to manage your own liquidity. But it often wouldn't work. The Reserve Bank was giving 5-day liquidity, 3-day repos, 4-day repos, especially when liquidity was tight. But with the re-emergence of the daily repo, that is really status quo ante, it clearly indicates a regime shift. We are going back to a position where the Reserve Bank is ready to stand by on a daily basis and give not unlimited liquidity as they used to, but give 50,000 crores. So that really counts as a change of mindset, and probably when it coincides with the governor and the most important deputy governor changing, it looks like a regime shift. It could be interpreted as one. Besides, of course, the easy liquidity is only 50,000 crores. The market deficit is more than 50,000 crores. You know, it's often a lakh crore and even more. But this is definitely some kind of a relief. The Reserve Bank is also doing something called swaps. They did it twice in the last 7 days. They sell dollars in the spot market so that the rupee doesn't depreciate too much. And then they do a buy-sell so that, the liquidity is provided back to the market and the liquidity withdrawal is postponed. Basically, the swaps are a liquidity infusing instrument. Given both these, the market is of the view that the Reserve Bank is on the side of providing more liquidity, and therefore possibly a rate cut in February can be expected. If the liquidity is very tight, a bank cannot pass on a rate cut. They will still want to keep deposit rates high so that they can continue to gather liquidity through deposits. Now, if the liquidity eases, then when the rate cut comes, it will get passed on. So all told, the markets are in a cheerful mood. Add to it the US CPI core CPI coming in lower than expected. There is a good 5-6 basis point fall in bond yields. And if you compare it to the high of the week, then it's a 10 basis point fall in the yields. So bond markets in a cheerful spot.
Absolutely, Latha. Thank you so much for giving us the explanation on this front.